All right. We are live. Yes, indeed. Oh, thank you, man. I really, really appreciate you so much. And so I appreciate everybody that's popping in today. You know, it's a Saturday afternoon. There's so many other things you could be doing. And I'm just always humbled and honored by anyone's time and attention because I know that there's so many different things you all could be doing. So, hey, thank you for hanging with us today. Hopefully, it will bring you guys some value and provide you guys some insights into, you know, your own trades, your own portfolios, and what have you. If you guys have questions, I know that we're kind of piping this out in a few different spots. You know, my YouTube channel, Mikey's YouTube channel, you know, the Discord. Just drop your questions in. I am actually going to do today kind of a little bit more like a Gary V type thing. We'll do mostly Q&A. I've got about 15 or 20 minutes of content kind of ready to, you know, talk about. But once we get through that, I really want to spend most of our time on Q&A because I feel like that does bring, you know, the most value. But just a couple of seconds about me because I know many of you may not even know who I am. My name is Jim Schultz, and I am a finance PhD, but my career in finance didn't start that way, and I didn't even think it would end up that way. When I was just a little tyke, man, and I started college, I knew I wanted to do finance, but I actually saw the movie Boiler Room, and I was like, oh, yeah, that's going to be me, like 100%. Like, that's what I want to do. I want to be a stockbroker. I want to be a financial advisor. Like, that's what we're going to do. That's how we're going to play this thing. Well, interestingly enough, that was kind of my trajectory up until the summer between my junior and my senior year. I did an internship at a financial advising firm at a brokerage house, and I had a great time. I met some wonderful people, and they offered me a job and all of that. But then I went back to school for my senior year, and the thing that really bothered me the most about that profession was I was like, man, if you really think about this, it doesn't have anything to do with finance. It has everything to do with sales. It has everything to do with relationships, and it has everything to do with being a people person, which is all good stuff. Those are all really wonderful things, but it just didn't jive with me because I just loved finance so much. So long story short, I continued on to grad school, MBA, PhD, and then started my career as a college professor. And I was a college professor for a little bit over 6 years. And then I had the unbelievable opportunity to join Tasty Trade back in 2016. I never thought I would leave academia, but Tasty Trade popped up at the perfect time. I got to know Tom, and the rest is history from a finance standpoint. And so I've been with Tasty Trade now for a little bit over 5 years, and F Cubed is my own personal thing. So for those of you that are watching on the YouTube channel, F Cubed is fitness, finance, and faith. And so finance is my professional endeavor. The fitness side, I also compete as a bodybuilder. And then the faith side is just trying to share the gospel with the world around me and maybe shed a little bit of Christ light onto the world, because I think we can all agree that the world needs some kind of light, regardless of what kind of light that might be. We do live in some very interesting times these days. And so that's a little bit about me. What I'm going to talk about here today is long premium and short premium, kind of buying options and selling options, because talking with Kevin, one thing that became clear is there's a lot of newer traders in the Theta Gang. There's a lot of like beginner traders, novice traders in this group. And so I thought, hey, let's go back to the basics, because we're in a very interesting market right now where, you know, it just feels like it goes up every single day. And the reason why it feels like it goes up every single day is because it does go up every single day. But this is not normal. This is very, very atypical. You know, I've been trading since I started trading in 2007, and I graduated in 2009 from grad school. And so let me tell you, new traders out there, this is very, very abnormal. This is not a normal market environment. It will go down one day. That day could be Monday. That day could be Friday. That day could be 2024. sure. Nobody knows. I don't know. Mikey doesn't know. Nobody knows. And so we just need to be strategically ready for that outcome because it is coming, someday in the future. And so I kind of wanted to talk a little bit about that, buying premium, selling premium. I think it'll be an interesting discussion around that. So, Kevin, Mikey, if it's cool with you guys, I'll go ahead and get rolling. But if not, just let me know. We good to go? All right, cool. So I'll probably take about 15 or 20 minutes, and I'm gonna dive into my Tastyworks platform and kind of walk through the concepts that I want to walk through, and then, like I said, we'll probably just turn it over for Q&A at that point. And so, all right, so let's hop into my. Let's see here. Oh, actually, hey Kevin, I need you to enable screen sharing so that I can fully share my screen there. Oh, there we go. Yeah. So that should be good. All right. So let me do. All right. So that looks good. All right. So now you guys should be able to see. You guys should be able to see my screen and all of my craptacular positions that I have on in my portfolio. But I don't have GameStop. I don't have GME. Somehow I avoided the GME disaster, and I know that there have been some questions about GME that have come in beforehand, so we'll loop back around to those here in just a couple of seconds. But what I want to focus on is buying premium and selling premium. So right now, right, it feels like you can predict direction. Like it feels like you know where the market is going because again, it just goes higher and higher and higher. I mean, it's pretty simple. You buy it in the morning, you sell it on the close, you make money. You buy it on the close, you sell it on the next day's close, and you make money. Well, you just got to be careful because it's not usually that easy. And so that's why I wanted to talk about, kind of buying premium and selling premium. So let's just go into, I'm just going to pick a market index, and we can talk about whatever stocks you guys want to talk about today, but I'm just going to pop right into SPY. So if I go into SPY, and let's say I choose the March cycle with 55 days to go. So I open up March with 55 days to go, and if I grab, so let's see here. Let me grab my box here. You can see that SPY is at, almost 383. So your at the money strike is basically right here. You've got your call options on the left. You've got your put options on the right. So let's kind of talk about just the very basic difference between buying an option and selling an option. So let's say that I was bullish on the overall stock market because, again, the market only goes higher. So playing it to the upside, seems like a slam dunk at this point. So you're thinking, all right, I've got the market at 383. I could step in here and I could buy this 390 call, let's say, right? So I'm going to click on buy the 390 call, and you can see that I'm going to pay a debit of $7 for that 390 call. And of course, the way that this works is I would need SPY to go up to 390, and then anything over 390 is just pure gravy, right? Anything over 390 is just going to be pure profit. If I grab my box again really quick, you guys can see what I'm trying to show here. Boom, max profit is infinitely large. There is no ceiling as to how good this could be for you. There is no maximum on how much you could possibly make. But the other thing that I want to point out that's very, very important is this number right here. So the theta on this position is negative 853. So what does that number even mean? Well, let's step back just 2 seconds. Here's the thing about buying options. So most, raise your hand, in your room, in your car, in your office, wherever you happen to be tuning in today, raise your hand if you started your options career buying options. I think everybody started that way. I know I started that way. I think everybody started that way. Because think about it, man. You buy an option, right? My risk is limited, right? My maximum loss on this is $700. If I'm dead wrong, the worst case scenario is I'm out $700, which, if you have a small account, you're only working with a couple $1,000s, like you're going to feel that, right? But in the grand scheme of things, it's really not that much money. And you could, of course, find options that are only selling for $100 or $50 or whatever you want to do. But the upside is unlimited. The upside is not capped. And so if you think about that risk-return trade-off, right? If you think about that gimme gotcha exchange, as I like to say, for every gimme there's a gotcha, you're like, man, that gotcha, it's only $7. But that gimme, that gimme has no limit. That gimme has no ceiling. And so that's very attractive to a lot of people. That's very much, this Powerball mindset, this lottery ticket mindset that just gets every single one of us, because I think that's how we are emotionally and behaviorally kind of wired. And so when we learn about the options market and we learn about, these derivative products and we see the potential here, it's like, man, I can control 100 shares of SPY. I only have to pay $700. If this thing just keeps screaming higher, then I'm going to make a ton of money. And again, this doesn't have to be SPY. It could be GameStop. It could be Tesla. It could be Plug. It could be any stock. It doesn't matter. You just fill in the blank, right? But here's the thing. You have to be right directionally. You have to pick direction correctly. With some of you, you're just glossing over that. Like that just went in one ear and out the other because you're like, Jim, I know where it's going. It's going higher. Like I've been watching the last 11 years. It's going higher. It's gone higher every single day for 11 years. So why would it stop going higher? Like that's kind of a fair point. But in the overall landscape of the market, when you look at a broad swath of market history, what you will soon realize is the market is very, very, very random. The market is very, very, very unpredictable. Here's actually a great example of what I'm talking about that we've all just experienced. Like I could talk about October 2008, but some of you maybe weren't trading in October 2008. Some of you maybe weren't even alive in October 2008. So we could talk about that, but it probably wouldn't make a lot of sense. I could talk about December 2018, but that's kind of a distant memory, at this point in, the game. Let's talk about last April. So what happened in April of 2020, right? The stock market crashed. The stock market collapsed. The stock market fell by 30% in a week or a month or whatever it was. I mean, it was a huge, huge drawdown in a short period of time. That's not the part where the market showed its randomness, though. That's not the part where the market showed its unpredictability. That was kind of like, man, this should have happened sooner. Right? Like COVID and the virus and the pandemic and all this stuff. And, the market took a while to go down. I mean, we knew about the virus, back in January or December or whenever it was. It took a little while for the market bottom to fall out. I think a lot of people would agree with that. Here's where the randomness really showed itself. It was in the months immediately after that. I'll tell you what nobody saw coming. Not a single person. You won't find anybody anywhere that predicted this happening. The stock market doubling off that bottom. The stock market roaring back to all-time highs within 12 weeks. I mean, look at the chart. It was a straight line higher. Nobody saw that coming, myself included, right? I mean, this was May. This was June. This was when everybody felt like, oh my gosh, I can't go outside. Like we felt like we were all we were like, what's that movie with Sandra Bullock? Bird something? Bird Box. We felt like we were living Bird Box. Like I can't even look outside. I can't even look out the window. And the stock market doubled. Nobody saw that coming. There was no vaccine on the horizon. There was no end in sight. We didn't even know. But the market just, for whatever reason, it just went higher. So that's a great example of the market randomness. So what I want to encourage you all to do today is if you buy an option, we're talking about buying call options now. You could, of course, make the same case on the other side of the market, the put side of the market. Just understand very clearly that you have to be right directionally, because if SPY doesn't move higher in this case, it doesn't go up to 390 or higher, you are going to lose that $7. You are going to lose that $700. But here's where it gets even more interesting. So let me erase all these boxes really quick. And let's see here. Let me go in and so let's erase these boxes. So right now we're in the March cycle, right? We're in the March cycle. We're looking at the 390 call. You can see that the theta on this call is minus $8.50. Here's what that means in a very simple sense. Every day that passes that you are not correct directionally, that option value is going to drop by $8.50. So today, it's $700. Tomorrow, it's going to be $692. The next day, it's going to be $684. The next day, it's going to be $676, and so on and so forth. And you're buying the option, so you want the value to go higher. You don't want the value to go lower. That's working against you. But here's where the plot thickens, and it actually thickens against you. So this is in March, right? This is 55 days to go. So what I'm going to do, let me close up March. Let's just go into like a nearer term cycle. So something that only has 27 days to go. So let me clear out that option. So now let's open up February with 27 days to go. And let's say that we were going to buy the same option, the 390 call. You can see that the cost of the option is less, but that's not really what I want to focus on right now. What I want to focus on is, let me grab my box again really quick. What I want to focus on is this number. Look at what has happened to the theta number. It is higher. Higher in the sense of its magnitude. It's obviously lower in a mathematical sense because now it's about minus $10. So every day that passes now is actually costing you $10. That's because this option is closer to its expiration date. So it doesn't matter when you buy the option. You could buy March with 55 days to go. You can buy February with 27 days to go. It doesn't make a difference. As time goes by, every day that passes when you buy options is costing you money, and each day that passes is costing you more money than the previous day. So what that means is this: you have to pick direction correctly, and you've got to pick it now. You've got to be correct right now. Otherwise, the hurdle that you have to jump over, it gets higher and higher and higher. Now, again, in today's market, all jokes aside, it just keeps going higher. It seems like it's going to be very, very easy. It seems like it's going to be very, very simple. But I will say this, and I've talked with, I've gotten to know hundreds, maybe thousands of traders over the years. And I can say with 100% honesty that I have not met a single one where buying options is the foundation of what they do. Not a single one. Some of them buy options. There's a time and a place to buy options. I'm not saying you should never buy an option. I'm not saying that a long option can't be part of your overall portfolio. What I am saying is, if it is the foundation, if you're being able to correctly pick direction is what you're hinging on, there's a very high likelihood that your portfolio is going to zero. There's a very high likelihood that you are going to continually lose money over and over and over again. So now naturally you might be thinking, well, all right, Jim, then what's the solution? Like what's the option? Pun intended. Well, don't forget, with an option contract, there's two sides. You don't have to buy it. You can be on the other side of it. You can actually sell options. So sticking with the same example here. So if we stick with SPY, let me close out this box really quick. With SPY, you've got SPY at 383. Let's say that I'm bullish on SPY. I still think SPY is going to go higher. Instead of buying this 390 call, what I could do instead is I could sell. I'm just picking a strike at random. I haven't done any analysis, or I'm not saying this is a good trade necessarily or anything like that. But I could sell this 372 put. So buying a call is a bullish strategy. Selling a put is also a bullish strategy. Now, if your head's kind of spinning because of that, then, that's because, buying options and selling options, if you're not used to selling them, it can really kind of turn the tables on you mentally. It can be quite a mind bender to work around. And we can do that on a future, webinar or training or whatever. Or you guys can always reach out to me personally too. I'm always more than happy to help if we were a little bit further beyond where you might be on an experience level. But from a bullish standpoint, you don't have to buy a call. You could also sell a put. Now, here's how this would kind of shake out. Just hitting kind of some of the highlights. The first one is this. When you go to sell this, let me grab my box here. When you go to sell this option, the first thing is you are not paying a debit. You are collecting a credit. So you're picking up $4.14. Your theta on this position is a positive number. Now, in this case, it's $12. The actual number itself doesn't matter. The simple fact that it's positive is what I want to focus on. Because this number is positive, here's what it means. Remember when we bought that call? Every day works against us. And every additional day works harder against us than the previous day. Well, guess what? If you sell options, and this would also be the case if you were selling a call, but that would be a bearish position, so to kind of stay consistent with our bullish bias. If I sell this put, my theta on this position is positive. So what that means is every day that passes, I don't have to be correct directionally, and the option value still goes down, but this time it benefits me. This time it works in my favor. And the reason why it works in my favor is because I'm selling the option for some number up here. I want the option value to go down. I want the option value to decrease. And so when time passes and the theta chips away at the extrinsic value in the option, that is a beneficial thing for me. That is going to help me. That is going to move me closer to making a profit on this position. As long as SPY stays above 372, I'm going to make money on this position. And I'm going to make money on this position because of the passage of time. Now, there's other ways that you can make money on the position. Like if it goes higher, you'll make money more quickly. There's also a volatility component. But I wanted to keep this, somewhat focused and somewhat narrowed down, because those of you who have been trading for a little bit, this stuff can get really, really complicated really, really quickly. So give me like 2 more minutes to wrap up my thoughts, and then I'll answer questions for at least the next hour or so, or until we run out of questions. If you sell an out-of-the-money put, which is what we've done here, here's the most important thing that I want you guys to walk away with from this little discussion. When you buy an option, you have to be right directionally. There's just no way around it. If you're not right directionally, then you are going to find it very, very difficult to make money, if not impossible to make money. But when you sell options, and you sell out of the money options, which is what we've done here. We've chosen a strike, a put strike that is below the current stock price. You don't have to be right directionally to make money. Because if SPY goes higher, if SPY rallies from 383, then you're going to make money. You're going to make money pretty quickly. You're going to see the cost of this option go down very quickly. So, you sold it for $4, you're going to be able to buy it back for $2 or $1, or hold it to expiration when it's not worth anything, and then you make the whole $4, right? There's strategies and there's maneuvers when it comes to that specifically, but we'll get into that at a later time. But the most important thing is this: SPY can go higher, you'll make money. SPY can go nowhere, you'll still make money. SPY can even go down a little bit. So you can be wrong directionally and you could still come out of this position with a profit. If you buy options and you're wrong directionally, that's never going to happen. You're never going to be able to salvage those positions. I can't think of a scenario where you'd be able to salvage that without adding more risk to the trade. But here, the beauty of selling options is you don't have to pick direction correctly, and you can make money. You can make money consistently, and you can make money for an entire career. And every single one of these traders that I've met and gotten to know and conversed with, selling options is the foundation of what they do. And so, we just barely scratched the surface, but again, I'm right at about 20 minutes. I didn't want to take too much time. For those of you who somewhat are familiar with my content, you know that I'll get one little nugget, man, and I'll go for like 45 minutes. So I got to be a little careful. I got to rein myself in a little bit. And so now, I'd be happy to take any questions you guys have that may have come in. I'm going to let Kevin and Mikey kind of help with those. And yeah. That's a great question. I'm glad you brought that up, because I wanted to get into this too, but I looked down at the time and I was somewhat aware of where I was at, but this is a great question. So, let's take a look at this. This is great. We looked at the long option, right? Where you're spending $700 and your max gain is infinitely large. Take a look at this scenario. Your max profit is $400. My max loss, you said $6,000. That's just your buying power. Theoretically, exactly. Let's be fair about this, right? Theoretically, if SPY goes to zero, you could lose 36 grand. So, I mean, if the stock market goes to zero, you will lose $36,000. Now, I can assure you, if the SPY does go to zero, you're actually not going to be worried about losing $36,000 because there's going to be bigger things happening that you're going to have to worry about. So theoretically, this is a possibility. Practically, it's not going to happen. SPY is not going to go to zero. Now, we can't say that about GameStop. We can't say that about Plug. We can't say that about individual stocks, but indexes, it's a pretty safe play that they're not going to go to their theoretical limits. But to answer your question a little bit more directly, this is it, man. I kind of referenced it a couple minutes ago. But this is the classic gimme gotcha exchange, right? The thing about options that it fascinates me, it frustrates me. It's just this constant waxing and waning of emotions. It's always a gimme gotcha exchange. For every gimme, there's a gotcha. You're never going to find a perfect system. You're never going to find the holy grail that's without risk. It does not exist. You have to give something up in exchange for something else. So when you buy an option, right, what's your biggest gimme? Your biggest gimme is unlimited upside. That's the biggest gimme on the board. And so that's why it lures so many people in. What's your biggest gotcha, or what are the gotchas that you need to be aware of? Well, it's basically what we talked about. Number one, you have to be right directionally. Number two, time is working against you. And so those are two big gotchas. I guess another gimme would be, your maximum loss is so much less than it might be with a short option. On the other side of the market, the gimme gotcha is exchanged. The gimme gotcha is flipped over. The most you can make is only a couple $100. Like in this case, it's $400. The most you can lose is $36,000. So most people, when they look at that, they're like, this has to be, there must be a trick in here somewhere. Like this just seems so obvious. Everybody should choose long options. Everybody should choose buying options. That's the only way you're going to make money in this marketplace. And so people look at this and they're like, exactly like what you said. This is just like picking up nickels in front of a steamroller. This is just like, this is ridiculous, right? There's no way that this is going to make money. Well, here's what's interesting. And there's so much research that has shown this. The research at Tasty Trade that we do, even academic research that I did and read and looked at when I was back in my Ph.D. and my professor days, it has shown this over and over and over again. 80% or somewhere thereabouts of options expire worthless. 80%, 8 out of 10 options expire worthless. So what does that mean? That means that if you're buying options, the stats are stacked heavily against you. So the way I'm looking at this situation is I'm like, okay, it almost feels like on the outset, I don't have a good option either way. I don't have a great option. Oh, there we go. Okay. I don't have a great option. I just saw your unlimited minutes, Kevin. Nice job. I don't have an option either way that looks super appealing. Because either A, I have time working against me on the long side, or B, I'm up against some really big losers on the downside. Right? Like, which option should I choose? Well, when I look at those stats, that 80%, with the deck stacked against me, I'm like, all right, that can't be an option for me. That can't be my core foundational strategy of buying options. And so let's try to make the other side work. And again, we just scratched the surface today, right? And we have so much more content over at Tasty Trade. And with my show From Theory to Practice and the Options Crash Course, I get into this in so much more detail when it comes to selling options. But some core strategy around selling options to help to mitigate those losers, to help to manage those trades that work against you. The GameStops, the plugs, the whatevers. I'm not going to lie to you guys, man. I'm not going to say it's never going to happen. Right? I'm not going to be disingenuous with y'all and say that you're never going to have big losers. You are. That's the gimme gotcha that you've signed up for. That's the exchange that you've absorbed. But I will also tell you this. If you really want to be consistently successful in this world, I'm not talking about buying a call and getting lucky and getting on Insta and telling everybody about it. That's not what I'm talking about. I'm talking about us having this conversation 7 years from now and you saying, yeah, I've been able to carve out a nice little patch for myself in this marketplace, making 8% a year, 12% a year, 14% a year. Whatever it is, right? But numbers that are grounded in reality, not 75% a year or 100% a quarter. Like, that's not sustainable. It's not going to last. And so I don't know, Kevin, I think I may have answered your question somewhere in there, but Let's do it, man. Yeah. Mm-hmm. 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 Yeah, so that's a really great question, and so a couple of things. So when it comes to leap options, you got to be careful with leap options. I'll just give a general kind of view and general comment, and then we'll dig into some specifics here with GameStop. You got to be careful with leap options because they look really good on paper. Like they look really good in theory. But then once you get into practice, it's a little bit different. It's a little bit different because, now you're going to have this position on, and we're not talking about, what I just said applies to all leap options, but it especially applies to a leap option like this in GameStop, in Plug, something like that. You have a leap option in SPY. You have a leap option in, GLD, the gold index. I mean, that's a little bit different because those things aren't going to move. GameStop moved $22 on Friday, right? It's like, that's not going to happen in the indexes, right? So you're going to be able to, sleep at night. You're going to be able to live your life without feeling glued to the screen to know what GameStop is doing. Because I'm going to tell you something right now. Like, this looks like a no-brainer. This looks like a slam dunk. Like, man, like, there's no risk to the downside, or there's $4 of risk or whatever. It's like, there's no way this isn't going to work, right? Well, I'll tell you what. You sell this option. Let's say you sold this option Friday on the close, right? Because you're like, man, there is no way. Look at GameStop. There is no way that this thing's going to go up another $20. I'll tell you who's been saying that for the last 18 months. Every single short Tesla position. Every single one. And what has Tesla done? It's gone up every single day by 3%, 5%, 7%, and then it split. And then after the split, people are like, oh, yeah, it's over now. No, not at all. It's almost back to its pre-split price. It's like halfway there. That's crazy, man. That's crazy. And so I don't remember who said this quote. It may have been one of the former chairmen or chairwomen of the Federal Reserve, but the markets can stay irrational longer than you can remain solvent. That may have been Alan Greenspan, actually. I'm not sure. But it's so true. And it's very true right now with GameStop. If you sold this straddle on Friday and you're like, oh, man, this is it, slam dunk, like this is the thing. I'm sending my kids to college with this straddle, like here it is, right? Well, GameStop goes up $15 on Monday. That's going to catch your attention. GameStop goes up another $18 on Tuesday. That's going to rustle your jimmies a little bit because you're going to be like, wow, I got to sit in here until January next year. Like, that's going to be a bumpy ride. And so not only do we see more opportunity in the shorter cycles, like 45 days to go because of the decay curve and where you're positioned, but there's so much more flexibility. And so just understand that when you look at a situation like this, and we can talk about more specifics around GameStop too, but I think this is a good starting point and it kind of addresses your question. When you look at a situation like this, I mean, I look at a situation like this and my knee-jerk reaction is like, wait a minute, did the market misprice this? Like, did I find something that no one else, has found? Which is obviously ridiculous to think right now because everybody's looking at GameStop. But you look at this and you're like, something's not right about this because there's basically no risk to the downside. I'll tell you what the market is effectively pricing in. The market is pricing in a very real possibility that GameStop is 200, in 3 or 6 months. Or by the end of the year, GameStop is 250 or 300. Again, you think it's crazy? Everybody thought it was crazy with Tesla. Everybody thought it was crazy with, Priceline back in the day. Priceline was like $3. And then the next thing you know, you look up and it's $1,150. And it's like, man, nobody saw that coming, right? And so is GameStop on the same trajectory? I don't know. And you don't know. And nobody knows. And so that's why, you know, risk control, position sizing, these things are so important. And so, you know, just from a GameStop overview position with the pricing metrics we see today, that would be my response. And we can talk about more specifics if people have specific positions or anything like that. But that's kind of how I would start that discussion. There you go. Yep. So let's start with kind of, and we'll use SPY because it's just a market index and it's going to help us make the point that I want to make today. Let's just start with some understanding around, you know, proper position sizing for your account size. So if we start with $10,000, so if I've got, I'm going to grab my, let me grab my pen here. So if I've got 10K, I've got $10,000. Let me just draw that on the screen there. So SPY is $382. So I'm just going to make this really simple. Let's say that it was $400. That would mean that 100 shares of SPY would be $40,000. So if I have a $10,000 portfolio, I effectively have 1/4 the exposure of 100 shares of SPY. If I look at my beta weighted deltas, so my beta weighted deltas, and let's say that, you know, so 100 shares, let's actually back up a second here. So 100 shares of SPY is 100 deltas. 100 beta weighted deltas. If you beta weight to the SPY. Beta weight deltas. So 100 shares is 100 beta weighted deltas. So if I have 1/4 the exposure of the overall market in terms of my account size, if I want to have effectively the same leverage as the whole market, like in other words, if I want my portfolio to move basically in line with the overall market, whether it be to the upside or the downside, market goes up by 1%, I would like my portfolio to roughly go up by 1%. Obviously, it's never that clean. It's never that simple because you have a lot of moving parts, but this is just a, you know, kind of a reference point. If I have 1/4 the exposure of SPY, then I would want to have 1/4 the exposure in my beta weighted deltas. So if I have $10,000 and 100 shares of SPY is $40,000, then 100 beta weighted deltas would be 4 times the exposure that I would want in my portfolio. I would want about 25 beta weighted deltas in my portfolio, because 25 beta weighted deltas in my portfolio is 1/4 the exposure of 100 beta weighted deltas from 100 shares of SPY. I have 1/4 the account size of 100 shares of SPY. So this makes sense from a leverage and exposure standpoint. Now, if you want more exposure than that, if you would like to have, 2x the exposure or, 3x the exposure, then you can, have 50 beta weighted deltas or 75 beta weighted deltas, or you can kind of work it out from here. My personal opinion, I don't think too many people should be more than 2x. That's just my personal opinion. If you talk to other traders, especially at Tasty Trade, some of them like to be up to 3x, 4x, 5x. Yeah, I don't like that. I don't like the gimme gotcha there. I don't like the heavy emphasis on direction when, again, we don't know where anything is going, especially not in the 45-day time horizon. Like, obviously the market's going to go higher over time. If the last 200 years is any indication, then it should go higher over time. Like, I think we can all agree on that. But what is it going to do, this month, these 45 days, this cycle, this year? I really don't think anybody knows. And so having too much of an emphasis on direction can be really, really problematic. But at the same time, it's fun. It's fun to be directional, right? Like I personally, I have a long bias in the marketplace. I've had a long bias for the last couple of years. Most of the traders at Tasty Trader are short. And so it's kind of fun, right? It's kind of fun to, kind of jab at each other and just have a bias and all that kind of stuff. Like I'm not saying not to have a directional bias at all, but just keep it kind of reined in and keep it kind of curtailed. Now, there was a second piece to your question. What happens if you're too directional? So what happens if, like right now, somebody out there they might have about a $10,000 account and they're like, yeah, Jim, I kind of like what you're saying. I like what you're laying down here today, but I'm looking at my beta weighted deltas right now and maybe they're like 90, right? So you're thinking, how do I get down to 25? Well, you basically have two options and they're both fairly simple. Number one, if you have 90 beta weighted deltas, and let's just say for the sake of argument that they're positive, it could be negative too. This applies to either side of the market. That means you have a lot of long positions. That means that you have a heavy directional bias to the upside. All you have to do is sell some of those positions or buy back some of those positions depending on which side of the market you're on. Close some of those positions. And then you can take this 90 beta weighted deltas and you can turn it into 60. You can turn it into 30 by closing current positions. That's one, avenue that you could explore moving forward. The other one is you could add new positions. So you have, positive 90 beta weighted deltas and you want to bring your deltas in line. If you have some capital on the sidelines, which we can talk about capital utilization and stuff like that too. But if you have some capital that you can put to work, then put on some bearish positions. Sell some call spreads, do some skewed strangles. You could buy some put spreads if you want to. Don't buy any naked puts. Hopefully you were listening, 30 minutes ago. But there's a couple different things that you could do from a strategic standpoint. So that's kind of what I would say. So hopefully that kind of helps everybody out there, Kevin. Oh yeah. Yep. Yeah, wow. So that's really good. Let me comment on what Mikey said though first, because that was really interesting. And so thanks for kind of sharing your view on not only the poor man's strategy, but just you're starting in 2009, basically having you basically started at the bottom tick. Like you basically grabbed the bottom tick, and that was the start of your trading career. And so that's pretty cool, man. Like that's really really cool. What's that? Yeah. No, I'm right there with you, man. No, totally. And to be clear, I actually am still bullish on this marketplace. I think that the conditions are still too ripe for economic growth and expansion. I mean, you mentioned the Fed and interest rates and things like that. I mean, it's prior to the virus. I mean, we had a robust economy in the United States, and I think we had a pretty robust economy globally. And I don't want to turn this into a macro discussion, but I just wanted to say that I'm actually right there with you. I think we might continue to see higher prices. I see the S&P hitting 4,000. I absolutely do. I see that happening, sooner rather than later. And so I'm right there with you. What I want to do though, and then I'll get right back into the poor man's covered call though. What I'm really interested in doing for everyone, especially someone who maybe hasn't seen too much sustained downward pressure on the marketplace, I just want to set everybody up strategically so that they're not only relying on direction. Because yeah, if you're relying on direction and you're correct, that's the fastest way to make money. There's no question. That is the fastest way to go from A to B. But man, that's a really, really big if. And I just want people to have a little bit more, let's say, strategic tools for their toolbox. And so by understanding, the probability landscape, by understanding, the out of the moneyness and the difference between buying options and selling options, it can really, really help. From a poor man's strategy though, so let me back up a second. I am actually a huge fan. You guys won't hear me talk about this too often on Tasty Trade because it doesn't really fit with what we do as active traders. And this might not even fit with a lot of people that are watching this today, but it'll make sense as to why I'm bringing this up here in a second. I am a huge proponent of the standard covered call. Standard. I'm not even talking about poor man's. I'm talking about buying the shares, stuffing them away in your sock drawer, and then selling calls against them. I love that strategy for a lot of people that I meet all the time, family members, friends, people that don't really want to be actively involved in the marketplace, but they want to harness the power that is available through products like options. And I'm like, hey, this is what you need to do. You need to be selling calls against your shares. I don't care how bullish you are. I don't care how right you think you're going to be. You just need another income stream. You need to diversify your profit pillars, your profit potential. And so I'm a huge fan of the covered call just as a generalized strategy. Now, honing in on a poor man's covered call, the poor man's covered call is a lot more capital efficient than a regular covered call because you're buying that 80 or 90 delta call option in place of the shares. That's only going to cost you a fraction of the capital. And then typically, you might skip a strike or two with your short option. I know you actually mentioned doing it in a leap style fashion, and so I'm kind of fascinated by that. I would probably choose the shorter term cycles, very similar to how Kevin kind of sets his up. I personally though, I don't love poor man's covered calls as an active strategy. That's not really something that I utilize a lot because if I'm going to tie up my capital in a 30 or 45 day time horizon and I'm going to want to have quick turnaround on that capital and I want to continually have it ready for new opportunities, the poor man's covered call is not really something that is forefront on my mind. I would much prefer to slide into a ratio spread or slide into a strangle or even a skewed strangle or even just a regular short put. Like those are kind of my go-to strategies because remember, right, with a poor man's covered call, you're still limiting your upside. So this is very much an apples to apples, conversation. Like if we're talking about naked calls, naked long calls against like a put ratio spread, that's like apples to like kiwi. Like that's completely different. But poor man's covered call, you are absolutely, limiting your upside there. And so I prefer to usually use other things like a ratio spread or like something like that. But I would probably if I was going to do a poor man's covered call, I would set it up very similarly to how Kevin did. Probably go, I can't remember exactly what you said there, Kevin, but probably go, about an 80 delta on the long call, maybe skip a month, give yourself a couple of months between the long and the short. And I think maybe you said you go a little bit earlier in time, maybe around 45 days, but I would set it up in a really standard approach. Buy the 80 delta call, probably sell, maybe a 30 delta call, 1 or 2 months into the future, and then just play the upside that way. So that's probably how I would do it. I have a quick follow-up question. What about just straight up short puts? What about what? Yeah. No, that was basically it. I typically find more things to say, but that was pretty much it. Mm-hmm. Mm-hmm. Yeah, no, I totally hear you, man. No, I totally hear you. It's funny though listening to you, Mikey, because I share a lot of the same sentiment as you. I actually, so like when it comes to undefined risk strategies, and I'll get to your question here too, Kevin, in a second. But when it gets to undefined risk strategies, ratio spreads, usually put ratio spreads, short strangles, and short puts are my top three. And if I had to put them in order, it would be put ratio spreads, short puts as like a 1A, 1B, and then short strangles is a very distant number 2. That's just my own personal feeling. Like, I understand that it's more strategic to sell the other side. I got all that. I understand the premium coming in from both sides, but I'm kind of with you. You know, because I have a long bias in the marketplace, and I started trading a little earlier than you, not much, only a couple years. I started in 07. So I did go through October 2008. So I saw a little bit of a hiccup or maybe a full vomit, however you want to classify that. I was there. I saw it. But I still kind of have a long bias. But man, I would encourage you. You're obviously experienced, but still, we all need a little pick me up. I would encourage you. I would encourage everybody else that's listening. If you have a bullish bias, just start selling some puts, man. Or maybe you just continue to sell puts. I wouldn't necessarily feel a ton of pressure to sell the call side if it doesn't jive with your view of the marketplace, especially if, and you kind of hinted at this, but I want to kind of elaborate on this, especially if you are ready to take the shares. You are ready to assume the bullish position. You are ready to roll and maneuver or whatever it is you need to do, right? I mean, if you're maxed out on the leverage and you're sweating it out because the put went in the money, like, that's a different story. But, even if you're using a little bit of leverage, if you're prepared to take the shares and potentially have that position for a while, something that you're going to have to nurse and kind of, care for, from an upside bias perspective, I say keep running the short puts, man, and maybe sell some dinky calls to bring in a little premium against it, but don't feel the need to be delta neutral necessarily. That would just be my encouragement. Now watch next week, the bottom's going to fall out, and we're all going to wish we sold the other side as a delta neutral, but that's kind of my view. But as far as Kevin's question, for people that might be out there that are like, man, I've never done undefined risk. I don't know where to start. I'm kind of scared, all that kind of stuff. We've all felt that way, all of us. Mikey even just kind of alluded to it just a second ago. I felt the exact same way back when I started out. I wish I would have known what I'm going to say next back then, because I think it would have made things a lot easier. My number one piece of advice for people that are starting out with undefined risk, I wouldn't worry so much about your account size, believe it or not, and I'll talk about that here in a second. I wouldn't worry so much about your account size. I probably wouldn't do it if I was just starting out with options. Like, if you're brand new and you're just learning their terminology, like you're like taking notes on like what calls are and what puts are and whatnot, you've got a little ways to go. I think I would probably build up a little bit more experience, buy some spreads, hey, buy some calls, buy some puts, and just get your feet wet with the market mechanics. But if you're beyond that point and you have a little bit of experience, the number one thing that you should do is just focus on low price stocks. That's all you got to do. That obviously are not named GameStop. So if you're focused on like SLV, like low priced indexes would be the best option for you. So then you can eliminate the GameStop, outlier that could potentially hit you. It's not going to happen. If you're focusing on SLV, that's a silver index. That's a $25 stock. If you're focused on XOP, that's one of the S&P sector indexes. That's a $40 stock or $50 stock. If you're focused on XLE, that's another S&P sector index. That's a $40 stock, right? All the X indexes like XOP, XLE, XLU, XLF, there's a lot of them. They're usually between like 30 and like $60, right? I would stay in like the $20, $30, $40 range, because here's what that's going to do for you. You can sell a put. You can sell a strangle. You can do a put ratio spread. You can do whatever you want to do. If you're just starting out with undefined risk, I would probably start with something very simple, like a short put. I wouldn't do a ratio spread and I wouldn't do a strangle, because I think it's going to be a little bit too difficult for you to follow what's happening to the position. But with a short put, it's only one thing. It's only one leg, so hopefully you can more clearly identify, what goes right, what goes wrong, and kind of everything in between. If you focus on a low-priced instrument, though, the benefit is no matter what happens, if that thing just goes ballistic on a $20, like SLV is a great example. Silver, $25 stock. If silver jumps by $5, that's a 20% move in silver. That's almost never going to happen. I'm sure it's happened once or twice in the history of whatever, for however many years or decades it's been. But it's a very unlikely occurrence. What's going to happen to your portfolio? You're going to be down like $400. And that's like the blackest of all black swans. Everything else is going to be somewhere in between. So you're going to get some experience, and you're going to be able to better appreciate how the different Greeks move, the delta, the theta, the vega, all these things, how they move in an unfiltered way when there is no long option, because it changes the game completely. Now, again, remember, you're on the short side of the option contract, so that changes the game too. But I would just start with low price stocks. It is the number one best piece of advice that I could give for somebody starting out with undefined risk. Yeah, so, that's a really good question, because I kind of have, there's kind of two different groups, and there's kind of two different factions of folks that I have seen be very, very successful. There's the kind of the tasty trade group and the tasty trade faction, where, we're focused on the 30, 45 day time horizon. We like the activity in the shorter term cycles. We kind of do exactly what you said there, Kevin. We don't look at the fundamentals. We don't look at the technicals. We don't look at any of those things. We're really just focused on the premium. We're focused on the liquidity. We're focusing on the strategic aspect of how a given position might fit in our portfolio. And what the company sells or does, or the service it provides, really doesn't factor in at all. There's a ton of opportunity to be successful in that arena. In that group of traders, in that group of like-minded people, there's a ton of opportunity for success, without question. There is another group, though, that I think Mikey might, he sounds like he's kind of a hybrid between the two. There is another group, though, and I kind of alluded to these people before, that just in the last couple of years, as people, I mean, obviously my family and friends, they all know what I do, and they know, what I have spent my life trying to learn and figure out, being the markets and options and all that kind of stuff. So I have an opportunity to communicate with a lot of them about their portfolios and about what's going on and things like that. And people who just want to use options as a supplement to an all stock portfolio, they can be wildly successful too, especially in, the greatest bull market that we've ever seen. And so anybody who's owned stock has done well the last 10 or 11 years. Well, anybody who has owned stock plus some options has potentially done even better. Now, again, if you bought Tesla at the bottom, no, you can't beat that. If you bought, GameStop, at the bottom, you can't beat that. Right? I mean, there's certain things, something that moves straight up in a vertical line higher, it's really difficult to beat. But for everybody that's kind of watching and listening and accessing, the talk today, you can be successful in a couple different ways here. You can take a more conservative approach. You can take a more kind of hands-off approach. Just have some stock and use options as a supplement. I'm not opposed to that. If somebody has something else they want to do with their life and they don't really want to be glued to their screens all the time and they just want to kind of have the strategies working for them, I'm all for it. I do think there's more opportunity in the more active space. Absolutely. But I respect the fact that some people may not want to do that. And I've just, I've met so many people over the years that, like, again, it sounds good on paper, but it's like, man, I got a life I want to live. I got kids. I got a wife. I got a husband. I got a job. I got this and that. It's like, I just kind of want to have these things working for me, and I pop in there every once in a while. So I want to encourage people out there, because I have a feeling you have, traders of all shapes and sizes. There's opportunity in a really active space, and there's opportunity in a less active space. I would just encourage everybody to, use options in some way to add that strategic diversification to their portfolio. And I think that everybody that's watching this through the Theta Gang is already doing that, so it's not a difficult sell. But that would kind of be my response there. Oh, wow. Oh man, awesome. Yeah, thank you. Yeah, actually, I didn't think about that, but as we were setting it up, yeah, you probably people that are watching on my channel, they can't hear you. They can't hear you or Mikey at all. And so I guess that was yeah, that would make sense that they can't hear him that well because they probably can't hear him at all. And so we'll have to fix that. We'll have to fix that for the next one. But sorry about that, guys. Yeah, Live F Cubed. I mean, on my YouTube channel, because I do so much finance stuff with Tasty Trade, with From Theory to Practice, and the other shows that I host, most of my YouTube sub is the fitness side and the faith side. And so, from a fitness standpoint, I've been a competitive bodybuilder for, I'm 39, and I started when I was 19. And so I've taken the stage more than a dozen times in a lot of different competitions over the years. And I grew up actually as a really, really big kid. I was made fun of. I was picked on. I was the fat kid in the group. I mean, I was all those things. And so when I graduated high school, I was like, man, like we got to do something different. And so I actually read Arnold Schwarzenegger's biography, and I was really inspired by that. And so from that, I found natural bodybuilding, and I've competed as a drug-free bodybuilder ever since. And in 2017, I was very fortunate. I almost turned pro in 2017. I took second at one of the shows that I did. I won the novice title, and I almost turned pro. And so the next time I take the stage, that's gonna kind of be the objective. But if anybody's out there that maybe they've been overweight for most of their life, or maybe they've been the big person in the group, like, hey, I've literally lived that life. And so I can speak to that, through firsthand experience. And so a lot of my content is tailored to that. It's for people that are really serious, that really want to make a lifestyle change or have made a lifestyle change, and they're very, very serious about weightlifting. They're very, very serious about training. They're very, very serious about, physique development. And so I try to come at that from every angle I possibly can, speaking directly to somebody that, they can't just show up and look great. Right? Like that's not the life I've ever lived, and so that's not really who I'm talking to. So if anybody out there kind of shares that same story, then some of the content from a fitness standpoint might be useful. And then from a faith standpoint, man, I'm a Christian, just trying to share the gospel, man. Just trying to share the gospel of Jesus out there with the world, and just try to speak truth into people's lives. And so sometimes we open up the Bible, sometimes we do some other things, and sometimes we just do some topical stuff, and other times we just kind of talk about what God might be speaking into people's lives. And so I feel like I have a pretty unique opportunity to kind of share the Bible and biblical truth with the world. And so I take that very seriously, and I treat it as a tremendous opportunity to bring God's kingdom into people's lives. And so for whatever reason, he's given me this little platform. And so I'm like, all right, let's talk about finance. Let me show you how to sell a put, right? Then let's talk about, back squats. Let me show you how to get the bar positioned, right below your traps, right above your rear delt. Like, let's do that. And then, hey, let's open up scripture, man, and let's actually read the real truth. And so we kind of mix it up a little bit. And like I said, from the YouTube side, it's mostly fitness and faith. I do some finance things every once in a while, like this, and maybe we'll do this again, in the future. This was a lot of fun for me, actually. And yeah, we do a lot of finance stuff with Tasty Trade and From Theory to Practice. So that's kind of the spiel. Yeah, I agree. Yeah. Oh well. First of all, I mean, Mikey, dude, like I'm really fascinated by your strategy and your approach, dude. We should do this again, man. Like let's have an interview. We can do it on your channel. We can do it on my channel. Whatever. We'll figure it out. Like let's do it again. We can do it again soon. You know, I think I heard a baby crying in the background. Is that right? Baby Becky. So is that number one for you? Oh my gosh, dude. Look at her. Oh, that's awesome, dude. Does she have GameStop on there? Oh my gosh. Dude, that's so funny. Oh my gosh, that's so funny. That's so funny. Um dude, yeah, no, let's do it again really soon and I'll get the audio fixed on my angle. I know what went wrong, but we can fix that for next time. But there 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 you go. And my email, Kevin, maybe you could write this in the chat. That'd be great. My email is just J, so my first initial, and then Schultz, so SCHULTZ, and then just F3, so Frank3 at gmail.com. And yeah, no, please, guys, I mean, hit me up on the YouTube channel. On social media, I'm just J Schultz F30 pretty much across the board. Twitter, Instagram, Facebook, all the regular ones, LinkedIn, all that stuff. Yep. Yep. So J Schultz F30 at Gmail. Yeah, there you go. Cool. Thank you guys. We'll see you next time.